Hello everyone and welcome to today's episode that we are going to talk about IPO's initial public offering as we expect SpaceX, OpenAI and Anthropic to go public this year, with SpaceX starting off very shortly in June, respectively, with OpenAI in October and Anthropic sometime in Q4 this year. You might have heard that there is one thing retail investors should never ever do, and that is buy company right at IPO. Why is that? When is a good time to buy? How the IPO plumbing works? Let's talk about it. IPO is some of the major event. Usually company would exercise since they might need to free up some liquidity. Reason being that for the number of years, company has been working or developing itself based on BDC or venture capital. Private capital, in other words, that has been held within a company for the last 5 to 10 years. And once the company has become mature enough and stable enough to be traded at the global stock exchange, could be New York, Chicago, London, Shanghai, you name it, depending on the profile of the company and the profile of the exchange, there might be a consideration to become public, which benefits obviously the company because they are able to finally offload some share options that some of team members might have held for extended period of times, and they were largely illiquid. Once company goes public, they become very liquid, and you can sell and buy them pretty much in any trading session within a day. Same goes for the venture capital firms. They have the shares within a company that now they will be able to sell and have a capital appreciation, which is also great news. IPO undoubtedly always benefits investment bank in charge of that IPO. And the only job of investment bank is to take process organization and make sure ideally that the opening price at IPO is actually going up towards the next year rather than down, and that participants in IPO on their side as well are rather happy. Participants on the side of investment bank in case of IPO would be hedge funds, index funds and pension funds. These are the guys who would be buying together with the investment bank the initial portion of shares at a discounted price. Think of it more or less 15 to 20% below the initial listing price. Then, on a launch date, company goes public, which also means that the shares are starting to be traded, and at some point during that time, they will be traded for the retail market as well. This is when the retail investors step in, and outside of the fact that they purchase the shares instantly at least 20% higher than most of the institutionals, there is also could be a lot of hype, which undoubtedly investment bank will try to create, so the shares will go up on the retail hype by itself. So technically speaking, we are looking into 15 to 30% of additional price that retail investor will have to pay versus the institutional one. And given the trajectory and the price compounding, retail investors usually would jump in into last 30% into that rally, which also creates another downward pressure when essentially within 90 days upon the IPO, in a number of cases, the shares will drop by 30% and they might drop all the way down to 40 to 50% in a window of 1 year. Additionally, why this is happening is because the insiders who've been holding those share options for an extended period of time, usually they have a certain restrictions as to when they are able to sell their shares. And believe me, it will never be on an IPO day. Usually that would be somewhere between 90 to 180 days. So this is the most vulnerable period of time when insiders will be selling their shares, and because they have a very early seeding capital, most probably they're going to have a substantial amounts of shares to sell. In a number of cases, some major shareholders will be even required to sell in batches. So for example, they may have so many shares that they will need to sell once every 180 days. And that's why you can see a certain downward pressure and certain circularity on how the sales volume of the shares on the market is increasing. So when is a good time to buy as a retail investor if you like the company and you believe in the company? Ultimately, you should not consider buying anything first 90 days. More conservative assessment will say that possibly 6 months to a year, this is a time when you can start opening some positions. But still, I would not recommend you going all in. Maybe you want to deploy your capital in batches just to make sure that you are not overpaying for the stock that you like. And additionally, I would love to share with you that because of the stock valuation of SpaceX in particular is going to be so high at the IPO, coming to $1.65 trillion. And obviously this company does not need the cash to keep the lights on, but they do need retail cash to make sure that all the interesting ideas where it pertains to interplanetary travel are meant to realize, and the budgeting and the valuation will not be holding it back. It also means that approximately 30% from that 165 trillion is expected to come from the retail investor, reaching somewhere around $500 billion in retail money, which is a lot. And for indices, it would also create an absolutely unprecedented case when they might need to sell companies like Magnificent Seven, think Apple, Google, Nvidia, Microsoft, to buy SpaceX, which in its turn is going to create a lot of volatility for Magnificent Seven companies towards the end of the year. And as a retail investor, you might want to consider it as an opportunity to buy or as an opportunity to take profits, depending on your current situation of whether or not you are holding those stocks already. I hope you found this video informative and educational. I'll see you the next time.